Hi, this is Clay with lesson number 6, which I call Ask the Expert. Consider the following. The financial industry in the US has been growing tremendously over the last few years to the point where now 6% of all US workers are employed in the financial industry. If you take their families, multiply 6% by the population of the US, that's about 20 million people that have to be clothed, fed, and housed. And here's the situation. You have this huge number of people making up the financial sector, and they don't actually produce a product in the way that Boeing Aircraft or a car company or a movie company does. But instead, they earn their living by taking a percentage of the money that they push around. Thus, they have created countless ways of digging into your pocket, my pocket, and everyone else's pocket in order to survive and to feed themselves and pay them a salary. And in terms of when you use these financial industry people, they will take their money in terms of many different guises. For instance, management fees, performance fees, sales charges, transaction fees, purchase fees, redemption fees, exchange fees, advisory fees, you name it. And so you have to be really careful because sometimes these are hard to find in the contracts of all the money that they're going to take out of your pocket. Okay, let's take a rather whimsical look at this situation. And this is from the movie The Wolf of Wall Street. You may have seen it. It's a movie based on a true character, Jordan Belfort, who starts out his life as a rather naive stockbroker at a firm in New York just before the crash, played by Leonardo DiCaprio. And this is a scene from the movie where he's on his first day at work. He's having lunch with the manager of the firm, played by Matthew McConaughey, and they're having a discussion. And Matthew McConaughey, well, not really Matthew McConaughey, but the character he's playing, gives him the following advice, which I'll let you read yourself up here. Just give you a second for it. So that might sound like a rather sort of jaded, pessimistic view, and you might say, well, that's certainly some characters, but not all characters on Wall Street. And you'd be right, not all of them are this bad. I mean, this guy here, Jordan Belfort, eventually ends up becoming one of the biggest scam artists on Wall Street and ends up in jail. But he's in his advice, if you distill out what he's saying, this is essentially what the financial industry is trying to do, is move the money from your pocket into their pocket. And second of all, that they don't know any more than you or I. Nobody knows what the market's going to do, but they have to pretend that they do. And if you'd like to, this is actually from the trailer on this movie. If you'd like to see it, you can click up here on The Wolf of Wall Street. This link probably won't work on a small portable device, but only on a laptop. Anyway, it's kind of an interesting movie, but it's kind of graphic. Okay, so here's another viewpoint, and this is from William Bernstein, who's written a number of books on investing. And this particular book is The Investor's Manifesto. I'm going to read this. Whether investors know it or not, they are engaged in an ongoing zero-sum life and death struggle with piranhas. And if rigorous precautions are not taken, the financial service industry will strip investors of their wealth faster than they can save Bernie Madoff. So you might say, well, I mean, this is kind of the low end of the financial industry, and certainly not all of the advisors and brokers, et cetera, are that bad. And it's true, but let's take a more qualified, respectable, reputable advisor. Now, it's not uncommon. In fact, it's typical for a financial advisor to take 1% of your money per year. And that's, if you say you had $100,000, what is that? $1,000. So you might say, well, that would be worth it because they know a lot more than I do about investing. And for measly 1% per year, I can afford to hire a professional. Okay, let's take an exact example. Suppose the US stock market returns 7% over the next 20 years. Now, the general wisdom or rule of thumb is that the market returns on average about 9.5% over the last 100 years. However, most analysts feel that's probably an overly optimistic rate to consider or plan on. And Warren Buffett recently himself said that because the market's been in such a bull market the last 5 or 6 years, that he would expect a more realistic return of 7% annualized over the next 20 years. So let's take the number of 7% over the next 20 years. And suppose you have a financial advisor that charges you 1%, but unbeknownst to you, he puts you in a managed fund that also charges 1%. So now you're paying 2%. Again, you might say, well, that's not too bad. It's a managed fund. You got all the pros working for me. But here's the situation. Your advisor and the manager of the fund cannot do any better at predicting the fund, the future of the stock market than chance, than you and I, than a monkey throwing darts at the financial pages. So let's compare if you do, in fact, just do average and you invest your money in, for instance, a Vanguard S&P 500 index fund with an expense ratio of 0.05%. And this happens to be one of the lowest index funds that I know of that you can find, but it's available to you or I very simply. And we'll talk about that later. So here's the situation again, going back. You've invested in, you've had an advisor invest for you, and he's managed your fund, and he's charging 1%, and he's putting you into another managed index fund, or not index fund, but managed fund that also charges 1%. Not an unrealistic situation at all. Now look at the results. And this is so critical that you understand this. If you start out with $100,000 over 20 years, the market return at 7% will almost go up 4 times, not quite, $386,968. However, you wouldn't get that return. You would have to pay an expense ratio, say if you were in the Vanguard S&P 500 fund, and so you would have a little bit less than that. You would have $383,668. However, the person, or you or me, who invested with a managed fund, an advisor who, say, took 1% and put it into a managed portfolio that charged 1%, the cost to you in fees over this 20 years, even at a low 2%, is going to be $118,000, almost 30% of your retirement, because you would have then ended up with only $265,333. So this is what you lost out being with a very respectable and reputable manager. So you've got to think about this. So important. So in summary, no one, brokers, advisors, experts, can consistently predict the stock market future. However, the financial service industry is always looking for a way to get your hand in your pocket. So they will always be convincing you that they can do better than if you do it yourself. They will take even a huge amount or a small amount, even a small amount, even a couple percent service fee can devastate your portfolio return. That's it. Hope you found that interesting and enlightening. So if you want, go to my No-Brainer Investor fee, nobrainerinvestor.com website. You can make comments on the websites, or you can send me an email to me specifically. Hope to see you in the next video. Thanks. Ciao.